I have a lot of liquidity. There is a lot of turmoil in the market. And while there's no guarantee of this, turmoil occasionally breeds real market panics. Turmoil occasionally breeds something like 2008. So mostly what I'm doing is I have a shopping list of opportunities that I'd like to avail myself of, companies in some cases, and I'm maintaining liquidity, looking to take advantage of that. I have a shopping list, frankly, of about 50 or 60 securities, as an example. And I have a nibble price, which is to say a share price that I would begin to establish a position in. And I have a gobble price, which is to say a price where I would really, really, really be an aggressive purchaser. On the other side of my portfolio, I have some speculative positions that I bought a year and a half or 2 years ago because they were really unloved. And I thought, well, I'm going to trade out of these things when they return to favor. So I'm doing that too. There are some companies that I think, in a speculative sense, are approaching their full value at this stage of the market, and I'm cycling out of those, looking for opportunities. So my portfolio is in flux. I would say that the dominant characteristic of my portfolio, relative to many other portfolios, is liquidity. I own, relative to the size of my portfolio, a lot of gold, and I have, relative to other portions of my portfolio, a lot of short-term cash. A lot of liquidity. But in addition to that, I believe that we're fairly early on in a gold bull market. I've lived through, this will be my fourth gold bull market, and they follow predictable patterns, Jesse. The metal moves first. When the metal has moved far enough, fast enough, that the gold price has outpaced the inflation in the inputs to produce gold, the margins in the biggest and the best gold companies move. You'll remember, Jesse, some frustration on the point of your listeners in 2003 when the gold price moved, but the gold miners didn't move. There were two explanations for that. One, the gold price moved because central banks were buying it. They don't buy gold stocks. The other was that the cost of producing gold was increasing as fast as the gold price. Beginning in 2024, the gold price accelerated faster than the inputs, and you started to see rapid margin expansions in some of the better gold producers. Two things happened there. They became worth more, but they got assigned a higher multiple too, as the narrative of the gold price extended to the gold miners. This occurs when you're usually about a quarter of the way through a gold bull market. So I suspect, if past is prologue, that we're a quarter of the way through this gold bull market. I believe, Jesse, that the cause of this gold bull market is primarily the deterioration in the purchasing power of the U.S. dollar, particularly relative to the interest being paid on U.S. dollar-denominated savings, which is to say negative real interest rates. And I believe that phenomenon will be with us for a fairly long time. Specifically, I believe in the next 10 years that the U.S. dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the U.S. dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the U.S. dollar, which is to say, I don't think that gold goes higher. I think it goes much higher. And I think that will expand the earnings of high-quality gold companies, and I think it will expand the multiples that they're accorded too. I think the gold-silver ratio is a factoid. I think it's a useful factoid for traders because so many people believe it. Something doesn't have to be true to be important. The gold-silver ratio refers to the difference between the relative price of gold and silver and their relative abundance in the Earth's crust. People like it because it's an easy-to-grasp statistic, but I think it's pointless. It doesn't take into account, as an example, the cost to produce gold or silver. Most silver is produced as a byproduct of other metals, which means the production costs for 78% of primary silver production is kind of irrelevant. It's low, unlike gold. It doesn't go to utility either. My experience has been that precious metals bull markets follow predictable patterns. The momentum is established by gold because the first buyer is a fear buyer. When the momentum in gold has attracted enough generalist investors that they come into the narrative, leadership changes from gold to silver, perhaps because of silver's relatively lower unit cost, perhaps because of its reputation, historical reputation for volatility. I don't know why, perhaps both. I just know that. When that happens, Jesse, you won't need Rick Rule to tell you it's changed. Those moves are generally very dramatic moves. So in answer to the first part of the question, I'm overweight gold. I have a weighting in silver, but my suspicion is that we don't see a real rip-roaring silver bull market for as much as a year or year and a half. And it's a higher risk circumstance. I have about 2.5% of my portfolio in silver stocks. It wouldn't surprise me to see that become 20% of my portfolio organically with no with no additions. But it wouldn't surprise me either to see that move take place 2 years from now, 3 years from now, 4 years from now. I have the financial and psychological wherewithal to wait 2, 3, 4, 5 years. Many speculators don't. I also have the psychological makeup that I can stomach a lot of volatility. Small silver stocks can increase or decrease 10% in price as a consequence of the disposition of one institutional investor. They can go up or down 10 or 12% for no reason whatsoever. It takes a fairly large degree of psychological maturity as a speculator to stomach that volatility. I've had 60 years to learn that kind of patience. So I can do it, but many can't.
Let me start by saying this. There's no shame in sitting on your hands when the market's behaving like a caffeinated teenager with a handful of firecrackers. I've been through enough cycles. Hell, I've probably forgotten more bear markets than most money managers today have lived through. To know that when turmoil surfaces, the worst thing you can do is start swinging blindly. Liquidity isn't just some academic concept. It's your parachute when the market jumps out of a perfectly good airplane. Now, I'm not forecasting a 2008-style event tomorrow morning at the open, but history's funny. Turmoil doesn't ring the bell on the NYSE and announce it's going to implode. It just does. And when it does, the people who survive and prosper aren't the ones who panicked last week and chased headlines. It's the folks who kept their powder dry, who had the discipline to build liquidity and the courage to buy when blood ran in the streets. That's what I'm doing right now. I have a shopping list, a long one, about 50 or 60 names, companies I know well, understand intimately, and have priced carefully. Each name has a nibble price and a gobble price. That's not just folksy terminology, by the way. It's strategy. The nibble price is where I begin to build a position, cautiously. The gobble price is where I back up the truck. But, and this is crucial, I don't chase. If these stocks don't get cheap enough to meet my criteria, I don't buy them. Period. There's no shame in missing out on opportunity. There's only shame in destroying capital by forcing opportunity that doesn't really exist. The market right now is confused. It doesn't know whether to fear inflation or recession or geopolitical war or all three at once. And in that kind of environment, cash is not trash. It's an option, one that lets you make decisions on your own time, not the market's. I hold a lot of cash. I hold a lot of gold. Those are my anchors. And yes, I still have a few speculative names that I bought when they were deeply unloved. Frankly, bought when nobody else would touch them. Some of those are getting long in the tooth, starting to return to favor, and I'm beginning to rotate out. But the bulk of my portfolio, it's in motion. It's fluid. I'm treating this market like a chessboard that resets itself every few weeks. What most people call volatility, I call opportunity, if you're ready. But again, you only get to take advantage of volatility if you have the cash to do so. I've said this before and I'll say it again. This is my fourth gold bull market, and they all rhyme. They all start with the metal itself, always. First buyers in these markets aren't looking for dividends or beta. They're looking for security. They're fear buyers. When faith in fiat starts to wobble, gold is where the money goes, not crypto, not Cathie Wood's latest ETF. Real money, real weight, real history. And when that narrative takes hold, when the gold price moves far enough and fast enough, something else starts to happen. The margins on the big mining companies explode. Think back to 2003. Gold was rising, but the mining stocks? Not so much. Why? Because input costs were also rising. Energy, labor, equipment, it all ate into the margins. So gold went up, but the producers didn't get more profitable. It wasn't until 2004 to 2005, when the gold price moved faster than the cost structure, that we started to see real margin expansion. That's when the miners took off. It's happening again now. Starting in early 2024, we've seen the gold price accelerate beyond inflationary pressures. That's widened the margins for the best producers, and markets are starting to notice. When that happens, two things occur. these companies become more profitable and they begin to command higher multiples. Why? Because generalist investors who couldn't spell metallurgy if you spotted them 4 vowels start piling in. They don't care that these companies mine through sulfides or oxides. They care that earnings are up and that they're missing out. And when that happens, your 10x becomes a 20x. I think we're roughly a quarter of the way through this gold bull market. It may not feel like it yet because the average retail investor still has one foot in meme stocks and the other in AI startups with no earnings. But the setup is classic. And the primary driver? Not war, not political risk, though those add spice. The main driver is the steady deterioration of the US dollar's purchasing power, particularly in real terms. If you're holding US dollar-denominated savings, you're being robbed silently every day. That's not hyperbole, it's arithmetic. So I'll say it again. Keep your liquidity, build your shopping list, know what you want to own, and at what price. Don't confuse activity with achievement. And whatever you do, don't forget, the real opportunity doesn't lie in guessing the next Fed move. It lies in seeing 5 years down the road and positioning accordingly.
We've gone through a period, 1982 to 2022, that were the most benign economic climate in human history, particularly for Americans. Real and nominal interest rates were falling. The U.S. dollar was strong, so we could export inflation. The benefit of demographics, which is to say the baby boomers, the benefit of global trade liberalization, a wonderful time. All that's changed, but I don't think that investor perception has changed. I think that we've been schooled through 40 years of benign times to be probably more aggressive, more positive than we ought to be. In the near term, with regards to Bank of America, as an example, the regulators in their wisdom have allowed Bank of America to say that those obligations aren't being held for trading, they're being held to maturity. And if they will pay off, that they can value them on their balance sheet, not at market, but rather at par. And I believe that not one investor in 20 knows the difference between mark to market. It's a legislative sleight of hand that people don't care about. The last time I saw people care, personally, was 1973. And that was an interesting change of circumstance. I don't know if the change of circumstance will occur. I happen to believe that the U.S. government will be able, in the near term, to roll over its debt, because I believe that the American people have looked at quantitative easing, that's Fed speak for counterfeiting, is a good thing. That's how you manage an economy without any pain to individual voters. It reminds me of the Hemingway quote. I'll only paraphrase it because I don't remember it. How do you go broke? Gradually at first, then all of a sudden. It becomes a problem when it's perceived to be a problem. I can tell you this. I'm delighted to be starting up a new bank that has no long bond portfolio, when so many of our competitors that might otherwise have competitive advantages over us with established banking relationships have real, true balance sheet constraints. The problems that I discuss in my work, 141 trillion dollars in private net worth in the United States against $130 trillion in net government debt, is a problem over a decade. What Porter describes probably is a problem over a decade. I think what investors need to focus on, and speculators too, is the fact that the way out of the dilemma described by Porter and the way out of the dilemma described by Rule is to reduce the purchasing power of the US dollar. You reduce the aggregate net present value of the debt while honoring the nominal value of the debt. In the decade of the 1970s, according to the Office of Management and Budget, the US dollar lost 75% of its purchasing power. This isn't a number put up by some cranky old libertarian named Rick Rule or a young copywriter, great thinker named Porter Stansbury. This is the Congressional Budget Office. By doing that, we devalued the net present value of the obligations run up by the war in Vietnam and the war on poverty. We got through it. It was ugly. There was a reckoning to get through it. Interest rates quadrupled. It was not a pretty time, but we got through it. And we're going to get through this too. Investors need to be concerned because we're heading into this period of turbulence with on-balance sheet and off-balance sheet liabilities in a real, not a nominal sense, that were 4 times as high as they were, which is to say there's less string to push. But we're also heading into it with a society that's enormously richer and more competent. If you look at the gains in technology and efficiency that we've enjoyed since the period of the 1970s.
Welcome back. Now that we've set the stage, let's dig into where the rubber meets the road how I actually construct my positions, and what I'm seeing right now in terms of real-world opportunity. A lot of investors, especially newer ones, want to skip the hard part. They want the stock tip, the hot name, the shortcut, but that's not how you build lasting wealth in this sector. This game rewards preparation, patience, and conviction. And above all, it punishes those who chase. When I build a list of 50 or 60 securities, it's not just a catalog of ticker symbols. These are names I've studied deeply, companies I've met, management teams I've interrogated, assets I understand. For each one, I assign two prices: the nibble price, which is the point at which the company becomes reasonably attractive and I'm willing to start accumulating. And then the gobble price, my aggressive entry point, usually corresponding to deep pessimism or outright panic in the market. And let me be clear, I don't move that gobble price just because I'm feeling itchy. Discipline is everything. This approach served me well through multiple crashes. In 2008, I bought some of the best companies in the world at cents on the dollar because I had liquidity and a plan. I wasn't surprised when the market crashed. I was prepared. That's where you make life-changing money, not during the euphoria but in the despair. Now with gold, the opportunity is here again. We're not in the early innings anymore. The metal's already moved, and now, just like clockwork, the money is flowing into the best gold producers. You can see it in their margins. You can see it in the free cash flow. Companies like Agnico Eagle, Franco-Nevada, and Newmont are suddenly flush. Investors are starting to wake up. The smart ones anyway. But here's the thing. We're not at the mania phase. We're in the recognition phase, where the big money starts allocating, but before the general public shows up. So what does that mean? It means the serious money is still to be made. Not in the metals themselves, but in the equities. The mining businesses. The companies with high-quality assets, strong balance sheets, and growing margins. If you're sitting on the sidelines waiting for a signal, this is it. You don't get a flare in the sky. You get margin expansion, you get institutional accumulation, you get rising volumes on up days and lower volumes on down days. That's what tells you the market's changing hands, from the weak to the strong. But there's nuance here. Not all gold stocks are created equal. The best of the best, what I call the royalty of royalty companies, are already moving. But the mid-tiers and juniors are still lagging. Why? Because the generalists haven't arrived yet. They're still in love with tech, still hoping the Fed has a soft landing magic wand. Meanwhile, the juniors are dirt cheap. This is where it gets fun, if you've done your homework. Some of these companies are trading at levels that assume $1,500 gold. Some have 20 million ounces in the ground and are being valued like they've just started exploring. And yes, there's risk. There's always risk in juniors. But risk isn't a four-letter word if you understand it. Risk is where returns come from. Just make sure you're being paid to take it. Now let's shift gears a bit and talk about silver. I mentioned in part 1 that silver moves later and more violently than gold. That's been true in every cycle I've lived through. Right now, silver is still finding its footing. The price action has been choppy. Sentiment is still hesitant. But make no mistake, when silver decides to run, it doesn't jog, it sprints. Why is that? Partly it's psychology. Silver has always attracted a certain type of investor, contrarian, impatient, often younger, sometimes romantic. It's the metal of rebellion. Partly it's structural. The silver market is tiny compared to gold. So when the capital flows come in, they have an outsized impact. A relatively modest amount of investment demand can overwhelm the available supply and send prices vertical. Now, I've got a fair chunk of my portfolio in silver equities, about 12% at the moment. I didn't go all in, I didn't bet the farm, but I bought companies with leverage to silver, both operational and geological, and I'm willing to wait. If silver takes a year or 2 or 5 to move, I can handle that. I have the financial and psychological capital to ride it out. But when it happens, and it will happen fast. And I'll be there. Most investors don't have that kind of patience. They see a stock down 15% in a week, and they panic. They look at silver's lag and decide it's a dead metal. That's fine. They'll be the ones buying from me at 3 times the price when the narrative shifts. Here's something I remind myself often. The market pays you to be early. It does not pay you to be comfortable. Comfort is what you get in an ETF tracking the S&P 500. Wealth is what you get from conviction deployed into unpopular assets at unpopular times. Let's talk real numbers for a moment. In the 1970s, silver went from $1.50 to $50. That's a 30 times move. In 2010, it went from under $10 to nearly $50 again. I'm not saying it's going to $50 next week, but if gold goes to $3,500 or $5,000, which I believe it will, silver at $100 is not absurd. It's actually conservative, given historical ratios and investment demand. That brings us to the gold-silver ratio. I've said before, it's a factoid. It's not gospel, but it's useful because so many people believe in it. Historically, the ratio oscillates between 40 and 80. At extremes, it tends to mean revert. Today, it's still elevated. If that ratio even just normalizes to 60 while gold goes to $3,000, that implies silver at $50. And if sentiment heats up, you could see triple digits, and not because of a supply shortage or industrial demand, but because of monetary panic. Now, a word of caution. Volatility is a feature of this space, not a bug. I've seen junior silver companies lose 50% of their value in a week for no reason. I've seen them triple in a month on nothing but sentiment. If that scares you, stay away. This sector isn't for the faint of heart. It's for people who understand that volatility is the price you pay for asymmetry. You want a 10-bagger? You have to earn it. Not with luck, with time. Let me offer a quick framework. In this sector, you've got three types of companies. First, the royalty and streaming firms, Franco-Nevada, Wheaton, Sandstorm. These are the safer plays. They generate cash flow. They're levered to the metal price, but not the operating risk. Second, you've got the senior and mid-tier producers. These are cash flow engines in a rising gold price environment. And then third, you have the juniors, explorers and developers. These are your lottery tickets. But unlike actual lotteries, if you know what you're doing, the odds improve dramatically. I like all three, but I weight them according to risk and timing. Right now, I'm heavier on the producers. But as the cycle matures, I'll rotate more into the juniors. That's where you get your 5x and 10x returns, if you pick the right ones. And that's the hard part. So how do you pick? Start with people. Great assets in the hands of bad people become bad investments. Marginal assets in the hands of great people sometimes surprise you. Then look at the geology. Look at the capital structure. Look at jurisdiction. And above all, ask yourself, if this company never raises another dime, can it still survive? If the answer is no, walk away. We're entering what I believe will be the most consequential gold and silver cycle since the 1970s. The dollar is deteriorating, real rates are negative, sovereign debt levels are unsustainable, and the geopolitical backdrop is fractured. This is not a time to chase performance. It's a time to build wealth, quietly, steadily, with discipline. Let me end with this. In markets like these, there are only two types of people, those who prepare and those who panic. I've spent my life preparing, and I suggest for your sake that you do too. Liquidity is your friend. Conviction is your weapon. Volatility is your terrain. Play it well, and the next 5 years could change your life. And remember, as I like to say, if you're going to be a contrarian, you better be right. And if you're going to be early, you better be patient. Until next time, keep your cash close, your eyes open, and your hands steady. Because when the herd runs, it usually runs in the wrong direction.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.